In this lecture, we'll discuss how the concept of total family balance sheet applies to the investment portfolio asset allocation decision and estate planning. By the end of this lesson, you should be able to identify assets that would be considered part of the client's investment portfolio, recognize the difference between asset allocation and asset location, and explain the importance of identifying each spouse's estate. Earlier in the program, you studied personal financial statements. The statement of net worth, or the balance sheet, is depicted here. The left side of the ledger lists assets in order of most liquid to least liquid. The right side of the ledger lists liabilities in order of shortest maturity to longest maturity. Total assets less total liabilities equals net worth. In this discussion, we'll focus on the left-hand column. In working with your client in regards to investment and retirement planning, an important question to consider is what assets should be counted as part of the investment portfolio. Clearly, not everything there is intended for investment. The question is important because it impacts the asset allocation decision. One way to think about the concept of what should and should not be included in is this. Investments are assets that you're willing to sell in order to generate spending capital or future income. Typically, the following assets are included in the investment portfolio: individual retirement accounts, personal investment accounts such as brokerage accounts and savings accounts, vested corporate retirement assets, the fair market value of secular or rabbi trust assets, the cash value of life insurance, property held for investment, and jewelry and collectibles held for investment. Assets that are intended for current use or consumption are generally not considered part of the investment portfolio. These include assets like the personal residence, a home, a condo, automobiles, wearable jewelry, collectibles or hobby assets, and other personal property such as clothing and recreational vehicles. Other assets that are generally excluded from the investment portfolio because of uncertainty are unexpected and expected inheritance, non-vested retirement assets, and non-qualified plans other than the secular trust and the rabbi trust. Additionally, monies in checking accounts that are intended to fund daily consumption are also ignored for purposes of the investment portfolio. When answering the question, it's not clear regarding if an asset should or should not be included, it's useful to zero in on the client's intent. For example, is the client willing to sell the asset to generate cash for spending or income? Alternatively, you might reflect on the purpose of the account. Is the account seen as a permanent investment or more of an account for spending money? The answer to these questions provide clarity. Previously, I mentioned that the home is generally excluded from the investment portfolio because it's a use asset. If the property is in a location creating meaningful capital appreciation, you might want to reflect on whether or not the client intends to downsize the home after retirement. If so, you might consider a portion of the home's value as a real estate investment. For example, let's consider the extreme case where your client lives in downtown Santa Barbara or Beverly Hills, but intends to relocate to Phoenix, Arizona to be closer to their children after retirement. The comparable cost of housing within the two locations is quite different. This is a conversation you're going to need to have with your client. Of course, there is some uncertainty, so lean towards being conservative, which aligns with the CFP and accounting curriculum. How will you value illiquid assets for purposes of determining the value of the investment assets? If you greatly overstate the value, then your asset allocation decision is compromised. For example, I remember a student in a capstone class who assessed a very high future valuation on the client's business. Based on that valuation, plus current saved assets, the student recommended that the client only had to contribute a couple $100 a month to fully fund the family's retirement portfolio. Of course, if the one-person practice failed to generate the projected multi-million-dollar price tag, then the entire retirement plan collapsed. That's aggressive, and it sets the client up for a major retirement shortfall. So, how are you going to value your liquid assets? How are you going to balance a reasonable estimate against the need for conservatism? Might you rely on the accounting basis or a fraction of the estimated value in order to create this margin of safety? The dollar value of the asset is also a factor. If the value of the asset is relatively small, then you may decide to ignore it for purposes of inclusion in the investment portfolio. One important aspect of asset location relates to taxation. Is the asset in a taxable account, tax-deferred account, or a tax-free account? Examples of taxable accounts are brokerage accounts and depository accounts. Examples of tax-deferred accounts include employer-qualified plans, self-employed plans, and individual retirement accounts. The Roth IRA is a tax-free account. It's important to not confuse asset location with asset allocation. A tax-advantaged 401k within an employer's qualified plan is an asset location. The equity and bond funds within that 401k are part of the overall mix, overall asset allocation. The asset allocation for the total family investment portfolio consists of the entire combination of equity securities, fixed income securities, real estate, alternative investments, and cash equivalents. As you learned in your investment course, factors influencing asset allocation include the need, time horizon, risk tolerance, preferences, and client constraints. Earlier in this lesson, you discovered that identifying which assets to include in the investment portfolio isn't always straightforward. Similarly, deciding on the asset allocation for the family's investment portfolio is not without challenge. There are complications when you view asset location from the total family perspective. For example, what do you do when clients or the spouses have different risk tolerances, or there are multi-generational family issues? Will you think about asset allocation from the perspective of a blended husband and wife portfolio, or keep the portfolio separate? How will you handle multi-generational assets, such as the business or investment properties? The intended use of an asset can also impact how to position the allocation. For example, consider a situation where the owner of a Roth IRA account intends to never liquidate those assets, they don't have to, but pass it on to the children, who can then extend liquidation for years and years. Would you simply remove the asset from the overall investment portfolio when you realize that the time horizon could be 50 or 60 years? Or keep it in the mix, realizing that intentions change? These are the type of issues that will require you to interact with your clients. Once you determine the total family asset allocation, you will implement the plan, and the types of securities that you will consider include mutual funds, exchange-traded funds, individual securities, private equity or private fixed income, and derivative securities, including options and futures. Let me just take a moment to review the optimal location of security types, a subject that you explored in your investments class. Based on CFP board curriculum, it is recommended, if possible, that you place municipal bonds, treasury bills, notes and bonds, and stocks held for long-term appreciation potential in taxable accounts. The logic here is that the securities either produce low annual dividends or interest income, or long-term capital gains, which are taxed at long-term capital gain tax rates. Alternatively, high-producing assets, stocks held for short-term appreciation, zero coupon bonds, and tips should be placed in tax advantage accounts. The logic here is that the securities produce high annual dividends, accrued interest, or short-term capital gains, which are taxed at ordinary income tax rates. The context of total family balance sheet is useful for purposes of positioning the investment and retirement assets in order to reach family goals and objectives. It's important, however, to still understand the individual's estates of each spouse for purposes of estate planning. As you learned in your estate planning course, estate is the name given to all assets owned by an individual. Per property and tax laws, each person has their own estate, and each husband and wife has a separate estate. It is recommended that you communicate the individual estate amount to each spouse. Those estates include assets titled to the spouse, insurance proceeds, business ownership, inheritances, gifts, and retirement plans. In this lesson, you learn how to identify what assets should be included in the investment portfolio. You are also reminded of the difference between asset location and asset allocation, and the importance of identifying the estate of each spouse.